how the election will affect your financial future. More specifically, stocks, bonds, and real estate. I'm going to explain this to you in 3 simple, fast steps. Step number 1, we have to understand it's all about one thing and one thing only. That is stimulus. It's just like cowbell on Saturday Night Live. The Christopher Walken skit, all I need is more cowbell.
More cowbell.
The markets right now, all they need is more stimulus. And to prove this point, let's take a look at a chart of the S&P 500 going back to March 2020 all the way to November, where we are today. On the left, we go from 2,250 up to 3,500. And although I was raising the red flag about the cerveza sickness way back in January, the markets definitely didn't listen to me. They kept going higher and higher and higher all the way to the end of February or so, maybe the beginning of March. And then they really started to crash. But then March 16th, right about here, the Fed finally stepped in with some unprecedented measures. To explore this further and go back in time, let's go straight to the internet. The Fed was supposed to meet on a Wednesday, but they had an emergency meeting that Sunday where Powell slashes interest rates to 0 as a part of a wide-ranging emergency intervention. The Fed announced Sunday it would drop interest rates to 0 and buy at least $700 billion in government and mortgage-related bonds as part of a wide-ranging emergency action to protect the economy from the impact of the cerveza sickness. The actions taken by the Fed were the most dramatic by the U.S. central bank since the 2008 financial crisis, and that is an understatement. To give this some context, QE3, $80 billion per month. QE Infinity, now at a minimum, $700 billion. And that article didn't even mention the fact the Fed committed to doing $1 trillion a day in the repo market if necessary. But on our timeline, you would think that the S&P 500 would have launched higher to all-time highs. But what ended up happening? The very next day, on Monday, the market continued to crash. And it crashed the whole rest of the week until we get to the next Sunday, where the government comes in and starts talking about a stimulus bill, the CARES Act. But that Sunday, it didn't pass. And when the market saw this, the Dow futures were down over 600 points. We move forward to that Monday, and it hits its low for the entire cycle, dropping over 1,000 points in just barely over maybe 3 or 4 weeks. A huge, huge crash in the market. Bear in mind, this is after the Fed came in with unprecedented action. Then on the 24th, we get rumors the stimulus deal is almost done and that it's over $2.5 trillion. What does the market do? It soars higher, just like the market used to do when we get this type of news coming out of the Fed. More on that in a moment. The 25th in the morning, we have some back and forth, and then that evening, the deal finally gets signed. It's official. The market races higher and never looks back. During this period, we had all the stimulus checks going out, all that demand increasing, and the income of the average American actually went up during 2020 as the economy was completely crashing. How did this happen? Because of the additional unemployment checks and the stimulus checks going to the average American. Oh, but wait, there is more. Of course, there's always more cowbell and there's always more stimulus, right about this time, call it July, August, the market started to level off because all of this stimulus spending was done. The checks had been received and there was nothing left to put in your newly formed Robinhood account, spend at Walmart, Target, or Home Depot. So the government comes in and says, well, maybe we'll do another round of stimulus. And the market continues to go up till this point in the middle of August, where they didn't agree to an additional stimulus package, but both Democrats and Republicans thought it would be a good idea to issue another $1,200. Market really likes that. It keeps going higher and then it comes down because the stimulus talks really started to dissipate. Were we going to get another stimulus package before the election? This was the big unknown. They tried to get it done, but we had a massive fail just after September. But then the Democrats came in with a new bill called the HEROES bill, ironically enough. That sends the market a little higher. Negotiations stall out on that. Everyone realizes no stimulus till the election. The market crashes down. And I'm not saying every single one of these moves was directly correlated to the news about the stimulus package. I am saying that these moves were definitely correlated to what was going on with the Fed and the government. That's for sure. This time frame, obviously, there's a lot of cross currents, but the main takeaway from this step is we have to realize we've gone from a Fed put to a government put. Now it's blatantly apparent the market doesn't care what the Fed does. All of the ammunition is gone. Regardless of how much QE or repo or any of these special purpose vehicles the Fed sets up, the market doesn't care. It will continue to crash. But what the market has told us is that when the government comes in and spends like a drunken sailor and the Fed monetizes the debt, then asset prices will continue to rise. But as soon as they get a whiff of no more stimulus, no more cowbell, or no more heroin, the market and asset prices start to go down. And when I'm referring to assets, I'm talking about risk assets in the broad S&P and stocks. We'll talk about bonds and real estate more in step number 3. Step number 2, the stimulus is taking us closer and closer to communism or socialism, however you want to define it. These terms are defined very loosely nowadays. But the bottom line is the more stimulus we do, the closer it's taking us to a centrally planned economy. Here's what I'm talking about. A chart going back to 1792. You can accuse me of clickbait all you want, but you can't accuse me of not having some fantastic charts and digging into the data. This chart goes all the way to 2018, but I've extended it to 2020 using some basic numbers that I'll review with you in just a moment. On the left, we go from 10% up to 50%. This is a chart of government spending as a percentage of GDP. Back in 1792, it was right around 3%. Said another way, 97% of GDP was coming from the private sector. Let that one sink in for a moment. We get to the Civil War and government spending goes up and it skyrockets. Wow, just over 10%. And then when it comes back down, it is at a level higher than where it began. This is something you'll notice is consistent every single time we get one of these spikes. But we're on the gold standard and we don't have this entity yet, the Federal Reserve, so it stays rather consistent. But then 1913 sets in, Jekyll Island and the Fed. You know what happened then. And oddly enough, we get World War I about 4 years later. Government spending does the exact same thing, goes up to 30% of GDP. You'll notice it comes down to a level far greater than where it began. We have the Depression, government spending goes up. I'd also like to point out that we had a depression here as well. that statistically was just as bad, if not worse, when you look at the drop of GDP and the unemployment rate. What did the government do? Nothing. And the depression lasted about a year. Here, the government stepped in and threw everything at it but the kitchen sink, and it lasted 10 years. I'll let you draw your own conclusions there. Government spending plateaus until we get to World War II. Then it really goes parabolic, up to 50%. But once again, where it comes down is a level much higher than where it started. And since the end of World War II, the government has just gotten bigger and bigger and bigger. Government spending as a percentage of GDP has continued to go up and up and up. And I think it is very suspicious that this started happening when we inserted the Fed into the equation. We basically went from Uncle Sam looking like this guy, ripped, jacked, just got out of the gym doing some curls. And we go from this guy all the way to our drunk, insolvent Uncle Sam, always there cross-eyed like a drunken sailor, just spending that money into the economy. Hasn't been to the gym in years, that's for sure. Only curls he's been doing, most likely 12-ounce curls. But like I said earlier, our chart ends at 2018. So what does government spending as a percentage of GDP look like now with the cerveza sickness and stimulus infinity? I did some back of the napkin math to figure this out. Keep in mind, I almost flunked out of high school. I probably didn't get above a third grade level in mathematics, but we can kind of put the pieces of the puzzle together. It's not that difficult. GDP in 2019 was right around 21 trillion, nominal GDP. Editor, let's go ahead and throw up a chart so we can show the viewers. At that time, government spending was about 40% of GDP, so we'll call it roughly 8 trillion. Back in 2019, the deficit, about $1 trillion. Now, almost $5 trillion. So a $4 trillion difference. What that means is that government spending this year is about $4 trillion higher than it was in 2019. But let's think this through. Let's just assume for the moment that GDP doesn't go down in 2020, which it most likely will go down dramatically. But let's just give the government the benefit of the doubt. It will give the government spending and the central planners the benefit of the doubt and say that GDP is still 21 trillion, the same as it was in 2019. But the government is spending an additional 4 trillion. So if they're spending an additional $4 trillion, which is accounted for in GDP, and the GDP numbers are the exact same, the private sector went all the way down to $9 trillion. That means that the private sector was only 43% of GDP, and the government climbed up to a whopping 57% of GDP. And to put that into context, let's go over here and think about if we were an economy that had 100% of GDP as a result of government spending. That would put us in the category of communism, and at the very least, a centrally planned economy. We've got to look at it this way. The closer we get to 100%, the closer we get to a centrally planned economy. The closer we get to 0%, the closer we are to a complete free market economy. Unfortunately, we're going in the wrong direction. And keep in mind, we might be at 57% now, but every single time we've had this spike, it goes down to a higher level and continues to go up and up and up, closer to 100%. So as we get more stimulus, more deficit spending, GDP doesn't go up. That means the private sector output goes down. We get closer and closer to communism, socialism, central planning, whatever you want to call it. Step number 3, Now we realize how important stimulus is to the economy and the stock market. We also understand the more stimulus we have, the more government spends as a percentage of GDP, the closer we get to 100% centrally planned economy, and the further we get away from free market capitalism. So now let's answer the question, how will the election most likely affect your financial future? 4 different options. The top line is the president, bottom line, Congress. So red-blue would mean Trump wins the election, but the majority of the Congress is Democrat. If this happens, I think that we will move closer to central planning. I don't think there's any going back. If you remember the chart in step number 2, once it spikes government spending as a percentage of GDP, it always comes down to a higher level than where it started. So because it spiked with the cerveza sickness so dramatically, I think if, that's a big if, we come down, it's going to come down to much higher than 40% where we started back in 2019. So we'll say our starting point is 57%. Again, that's the number that we had in step number 2. So if Trump is elected, but they've got this combative nature, meaning he can't really pass anything because the Congress is mostly Democrat, I think we move closer to central planning, but it's just in first gear. And this really goes back to how much stimulus I think they'll be able to pass. The more stimulus, the more government spending, the higher government spending is as a percentage of GDP. And if nominal GDP stays the same because we're in a recession, that means lower economic output from the private sector. If Biden wins, we have a Republican Congress, then I think we're moving closer to it, but still maybe in second gear. If we have Trump and a Republican Congress, I think we really start to move towards it because we'll get a lot of stimulus. So now we would be moving towards central planning in overdrive. But if we have Biden and a Democratic Congress, I think we move towards central planning in warp speed because I think they are going to unleash a massive amount of stimulus over the next 4 years, possibly set policies into place that will be with us forever, such as universal basic income. So looking at this just through the lens of stimulus, how would these 4 different outcomes potentially affect stocks, bonds, and real estate? Let's think this through. If the presidency is red and the Congress is blue, it's going to be tough for them to pass more and more stimulus. Therefore, I think downward pressure on the stock market. Bonds, most likely flat. I don't think anything's really going to change there. And even if they went up slightly, even if interest rates went up, meaning bond prices went down, the Fed would step in and peg the yield curve. The only thing that's going to stop that is going to be future inflation. Depends on how much MMT we get, going back to last night's video. Real estate, I think it remains pretty flat. I don't know what a driver would be. Pretty much the same there. Although there's very low supply, people's stimulus checks will be running out and all that additional income they had will be running dry. And I think a lot of those unemployment checks or stimulus checks went into a down payment to purchase a home. If we have a Biden win red Congress, I think the stock market's way down because then it's going to be tough to get stimulus, but we might have additional corporate taxes. Bond prices flat or up, meaning interest rates down. The reason I see this potentially happening is because if the market's crashing, the Fed's going to do anything they possibly can, and that's going to be buying bonds, getting interest rates as low as they can get them in the real economy. In this scenario, I think real estate would have more tailwind because mortgage rates going down because the Fed's trying to get those rates in the overall economy as low as possible. If we have red and red, I think the stock market goes up because we're going to get that stimulus package passed. I think bonds pretty much stay flat until we get some inflation. I think real estate goes up because we're going to have a lot more stimulus. And if we have blue and blue, I think the market goes way up. Believe it or not, even though we have that headwind with corporate taxes, I think we're going to have so much stimulus. And going back to that chart we looked at, the S&P 500 in step number 1, you can see stimulus now really matters. It's all about the government put. Inflation expectations in the marketplace would probably increase because of all this additional government spending and stimulus. Therefore, bond prices probably down, meaning interest rates going up slightly. But I think the Fed eventually would come in and peg the yield curve. So not down too much as far as the prices. Real estate, I think we could see a lot of tailwind there with reduced supply because higher and higher regulations. You combine that with additional stimulus, more money for down payments means higher demand, lower supply. But I want to be very clear, these are not predictions. I'm just looking at headwinds and tailwinds through the lens of stimulus based on how much stimulus I think we'll get with each one of these different scenarios. But honestly, I think if we just focus on asset prices, whether or not your 401k is going higher, what's happening with your home equity, we're missing the bigger picture. Whether we like it or not, we have to be cognizant of the fact that the United States and most of the Western developed economies are moving closer and closer and closer to a centrally planned economy and further away from free market capitalism. Even if your 401k goes up or your home price goes up in value, you might feel great because you have more purchasing power, but what does the country you live in look like now compared to 10 years ago, 20 years ago, 30 years ago? What I'm saying is, how much does it really matter if you get richer while society is deteriorating? Most of you know I spend a lot of time outside the United States. I don't see it day after day after day. A lot of times it can be a year or two before I'll come back. And I can tell you this last time I've come back to Phoenix, a place where I've spent a lot of years over my life, I've never seen more homeless people. The divide between the haves and the have-nots is getting more and more extreme. And it's not because we have more free market capitalism. It's because we have less free market capitalism and more central planning. So you have to remember, if you are long the stock market, the S&P 500, if you have one of these typical 60-40 portfolios, you're not long the stock market, you're long stimulus. And if you're long stimulus, you're long central planning. How many of you watching this video right now say to yourself, well, I think the more central planning we have in the United States, the better that should be for the stock market. Therefore, the more central planning we have, the more I want to buy stocks. Of course, none of us would say that. We know what happened in Russia. We know what happened in China. We've seen it play out all over the world. Central planning never works. It always ends badly. Regardless of who wins the election, we're rapidly transitioning into a society and an economy where the only way to get ahead is not through your labor. It's not through producing goods and services. It's through political pull and political favors. Let's cut to one of my favorite quotes from a book going all the way back to 1957 that describes what's happening in the United States today far, far better than I can. Watch money. Money is the barometer of society's virtue. When you see that trading is done, not by consent, but by compulsion, when you see that in order to produce, you need to obtain permission from men who produce nothing, when you see that money is flowing to those who deal, not in goods, but in favors, when you see that men get richer by graft and pull than by work, and your laws don't protect you against them, but protect them against you. When you see corruption being rewarded and honesty becoming a self-sacrifice, you may know that your society is doomed. So in my opinion, the question we should be asking ourselves on this election day is not if we get to Atlas Shrugged, but more so when we get to Atlas Shrugged. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.